You see it in your account. The balance is there. The statement confirms it. The system recognizes it under your name. And yet, legally, structurally, functionally, you don't own it. If ownership means control, why can access be paused? If it belongs to you, why is it recorded as someone else's liability? If it is property, why can it be converted, restricted, or reprioritized under stress? The contradiction is not accidental. It is foundational. This is not a philosophical argument. It is a legal and structural one. Modern money, as held in banks, is not a stored asset in your custody. It is a claim against a leveraged institution operating within a regulated monetary hierarchy. What appears as possession is, in fact, participation in a system built on credit, liquidity management, and prioritized claims. To understand why ownership is conditional, we begin with the mechanics. When you deposit money into a commercial bank, you transfer legal title of that money to the bank. In exchange, you receive a contractual claim. The bank owes you an equivalent amount. Your balance represents that obligation. It does not represent segregated property. The bank can lend the funds, invest the funds, use them as collateral. Your deposit becomes part of its asset liability structure. This model is known as fractional reserve banking. It is not fraudulent. It is standard. It allows credit creation beyond the base monetary supply. Loans generate deposits. Deposits support further lending. The system expands through confidence. But expansion embeds dependence. Dependence on repayment. Dependence on liquidity. Dependence on continued confidence. If too many depositors demand cash simultaneously, the bank cannot immediately satisfy all claims. Not because assets do not exist, but because they are illiquid in the short term. Liquidity is timing, solvency is valuation. Ownership exists somewhere between the two. In stable periods, this distinction feels irrelevant. During stress, it becomes decisive. Throughout monetary history, access has been interrupted before value disappeared. In 1933, U.S. banks closed temporarily under a national bank holiday. Depositors still had balances. They did not have access. In Argentina in 2001, withdrawal limits were imposed to prevent capital flight. Accounts remained intact. Liquidity was rationed. In Cyprus in 2013, uninsured depositors saw portions of their balances converted into bank equity to recapitalize institutions. The funds were not stolen. They were reprioritized. The legal architecture allowing this existed long before the crisis. Most depositors did not examine it. Late realization arrived when the mechanism activated. Modern regulatory frameworks increasingly incorporate bail-in procedures. Instead of relying entirely on taxpayer-funded bailouts, authorities may require shareholders, bondholders, and certain depositors to absorb losses during bank resolution. Deposits above insured limits are unsecured claims. They rank in a hierarchy. Hierarchy determines outcome during stress. Most account holders never consider their place in that hierarchy. They assume ownership. They possess a claim. A claim is not the same as property. This distinction rarely matters in calm periods. It defines outcomes in turbulent ones. The mechanism gap widens here. If deposits are claims, what ensures those claims remain accessible? Liquidity support. Central banks act as lenders of last resort. They provide emergency funding to banks facing short-term cash shortages. Through repo facilities, discount windows, and asset purchases, they stabilize institutions. These actions preserve system continuity. They do not change the legal nature of your deposit. Your balance remains a liability on a leveraged institution's balance sheet. If stress escalates beyond manageable liquidity injections, authorities may impose restrictions, withdrawal limits, capital controls, transaction freezes. These measures are not default responses. They are contingency tools. The tools exist. They are written into law. They are rarely activated. Their existence alone reshapes the meaning of ownership. Digitalization deepens the condition. Physical cash once allowed partial autonomy. Banknotes in hand were bearer instruments. No intermediary could pause their use. Digital balances require mediation. Every transaction passes through a network. Clearing systems, compliance filters, risk algorithms. An account can be flagged automatically. Transactions can be halted pending review. Funds remain visible. Permission is paused. Permission governs usage. Usage defines practical ownership. The illusion of safety rests on routine functionality. Routine masks structure. As digital payment systems expand and cash usage declines, mediation increases, centralization increases, visibility increases. Visibility enables oversight. Oversight enables intervention. Intervention need not be dramatic to be effective. A delayed transfer, a reduced limit, a compliance hold. Each represents a reminder that access is conditional. Consider credit lines. Many individuals treat credit limits as extensions of their own liquidity. Yet banks can reduce limits or close accounts based on internal risk recalibration. These actions are contractual. They are discretionary. From the individual perspective, reduction feels arbitrary. From the institutional perspective, it reflects risk management. Risk management operates on aggregated data. Individuals operate on personal expectation. Institutional asymmetry emerges. Institutions anticipate systemic signals. Individuals respond to localized consequences. Sovereign debt introduces another layer. Governments finance deficits through bond issuance. Banks hold sovereign bonds as assets. Sovereign stability influences bank solvency. If sovereign debt pressures intensify, banking stability may be affected. Policy responses may include financial repression. Interest rates held below inflation. Capital flow restrictions. Liquidity prioritization. None of these are announced as redefinitions of ownership. They are framed as stabilization. Stabilization preserves the system. Preserving the system may involve altering claim fulfillment timing. Currency erosion compounds the issue. Inflation reduces purchasing power gradually. If deposit interest fails to keep pace with inflation, real value declines. No confiscation occurs. Value diminishes through arithmetic. Ownership remains nominal. Effective purchasing power declines. Slow erosion is less visible than abrupt seizure. It is also more persistent. The consequence gap emerges. If deposits are unsecured claims in leveraged institutions within debt-saturated economies, what happens as leverage expands further? Global debt has risen substantially over decades. Sovereign, corporate, and household obligations accumulate. Higher leverage increases sensitivity to rate changes. Rising rates increase servicing costs. Increased servicing costs elevate default risk. Elevated default risk pressures banks. Pressure prompts tighter lending standards. Tighter standards restrict credit availability. Restricted credit slows growth. Slower growth stresses debt sustainability. The loop reinforces fragility. Fragility necessitates preparedness. Preparedness includes resolution frameworks. Resolution frameworks define claim hierarchy. Hierarchy determines loss absorption. Depositors often assume senior status. They are senior relative to equity. They are not immune. The system is designed to prioritize continuity. Continuity may require temporary reprioritization of claims. Reprioritization does not mean collapse. It reveals structure. The final closure of the mechanism gap lies in understanding that ownership in modern finance is layered. At the base lies sovereign currency. Above it, central bank reserves. Above reserves, commercial bank liabilities. Above liabilities, individual deposit claims. Stress at lower layers propagates upward. Adjustment at higher layers absorbs shock. Absorption may involve delay. Delay may involve restriction. Restriction clarifies that the deposit was always a claim. You don't own the underlying assets, you own a promise. A promise backed by solvency, liquidity, and policy. Policy is discretionary. Discretion expands during crisis. Crisis is not always dramatic. It can be slow. Gradual rate increases. Gradual inflation, gradual tightening. Each adjustment appears manageable. Collectively, they reshape structure. Ownership becomes increasingly mediated. Your money exists inside an interconnected system designed to manage risk collectively. Collective management requires authority. Authority requires flexibility. Flexibility requires hierarchy. Hierarchy determines whose claims are fulfilled immediately and whose are deferred. This is not an accusation. It is an architectural description. Most of the time, the promise holds. Access remains uninterrupted. Confidence persists. But the legal and structural reality does not change. The deposit is not property stored in trust. It is a liability recorded on a leveraged institution's balance sheet. It functions as money because the system honors it. It remains usable because liquidity is available. It feels owned because routine is stable. When routine falters, the distinction becomes visible. not through dramatic confiscation. Through procedural adjustment, through delay, through reprioritization, through subtle erosion. The system does not need to announce that ownership is conditional. It operates that way by design. And by the time that design becomes visible, the structure has already been in place for decades. You don't own it. You participate in it. And participation depends on stability, policy, and hierarchy, far beyond your individual balance.